What is going on, traders? Welcome back to the Traveling Trader. In this video, I'm going to be talking about 5 stocks that I'm currently looking at based on the market conditions at the moment. Right now, the market is hinging on a few different storylines, as I've talked about before. One is the obvious Delta variant and whatever variants come thereafter. Number 2 are the treasury yields. Are the current bond yields reflecting that the market thinks that inflation is, as a matter of fact, transitory because bonds are being bought up in droves? 3 is a potential economic slowdown. Have we grown so fast coming out of the pandemic with record GDP growth that right now we are seeing an element of demand destruction and potential pullback in the economy? And number 4 is the unfortunate shenanigans going on with China as they continue dumping commodities, bringing US commodity prices down, as well as cracking down on their own businesses internally, which just seems counterintuitive. There are obviously a few more factors than that, like the rising price of oil and whatnot, but we'll leave these out of the equation. So with those current market conditions, are there opportunities in the market? Like I said, I'm going to be looking at 5 stocks at the moment. I will give you those plays towards the end of the video, so you definitely want to stick around for that. Welcome back to the Traveling Trader. If you got anything out of this video, leave it a big fat thumbs up just like this. Let me know in the comment section below which one of these stocks you are trading and what you think of the current market conditions. Is the market going to correct soon? Are we going to continue to melt up into next year? What do you think of the bond yields, etc.? I'd love to know your thoughts. Leave it in the comment section below. And without further ado, let's get right into it. So first we'll do a brief market update, then get into the plays. So next week, July 13th, we are expecting the new CPI index for June. This is the consumer price index that gives us an indication of what inflation was like and where inflation could be headed. Now, this is important because it allows us to guesstimate whether the Fed is going to be implementing strategies such as tapering, bond buying, and or rising interest rates, which I don't think will happen until at least next year. It will also give us an indication on economic recovery. If inflation is significantly down, then we are likely past the hyper-growth stage of the economic recovery. The 10-year note continues to drop, although it found support at the 200-day moving average. For those of you that are fans of this channel, you know that we bought puts on TLT, which moves inversely to the 10-year note. Now, we are still slightly down on those, but I'm expecting a bounce here on the 10-year note. And if this continues to go up, then our puts on TLT will actually print. Those expire later in August, so we have quite a bit of time. If you want access to all of our trades, link is in the description below. So the current 10-year note sits at around 1.35, 1.36%. Now, if the market is interpreting that inflation is transitory, meaning temporary, then there could be a wave of bond buying, which would then keep dropping the yields because there is an inverse relationship between bond buying and the rates, right? The more that people buy bonds, the less attractive the rates become. The less people buy bonds, the more attractive rates become, meaning the higher, because they want to attract investors into the bond market. So if in fact people or the market are interpreting that the inflation rate is transitory, is temporary, that means that they will likely rush into buying bonds because this is the best rate that they're going to get at the moment. And they want a surefire investment to help beat inflation or beat the inflation rate, if that makes sense. However, I will continue with the TLT puts as a hedge. And as I said, in terms of the Chinese business landscape, they are really ramping up their brinksmanship here with their currency manipulation, as well as the tightening of credit availability to businesses and corporations internally in China. If you take a look at KWEB, which is the ETF that tracks the Chinese internet companies, you'll see that it recently hit a low that we haven't seen since over a year ago in June 2020 when the pandemic was just fresh. Stocks like Alibaba and Baidu are also at those year lows. So does this provide a lucrative opportunity to buy discounted Chinese internet stocks now? Or are these still risky investments? In my view, we've seen the China FUD happen time and time again, and that is why these stocks continue to remain volatile. However, if you can stomach the volatility, then these mega cap Chinese stocks like Baidu, like Alibaba, like JD, etc., there is still an opportunity here. Again, if you can stomach the volatility and you can hold these stocks until they hit their recent highs once again, I do think there's an opportunity there. However, it does come with risk. We never know what the Chinese government is going to do, but Chinese FUD is just the norm in terms of the stock market. Now, don't worry, none of the stocks that I mentioned are actually Chinese stocks, although, as I said, I think there is a lucrative opportunity, assuming that you have the stomach for risk and you know how to portfolio size adequately. All right, so in terms of the stocks where I think there is a significant opportunity, first one is DraftKings. We actually sold cash secured puts on DraftKings, ticker symbol DKNG. currently sitting here at the 300-day moving average. Now, it is forming a bearish pennant here, so there could be a chance that we could break to the downside. However, at less than $50, there could be a gainful opportunity here on DraftKings, especially since football season is not that far away. Remember that online sports betting in the United States is still an infant industry with only a few number of states that have legalized it. It's the same thing with cannabis. Those two present a very long-term opportunity in my view. It is still by far and away the market leader in daily fantasy sports gaming, and it is projected to 4x its revenue in the next 4 years. In the private trading group, we closed our $45 cash secure put on DraftKings in June for 50% profits, and we opened up another one just last week at the $45 mark as well. Not to mention, we had a risky diagonal spread on DraftKings that was up almost 300% in less than a day. Check that out in the Discord if you want details on that trade. But for those reasons, DraftKings is a stock that I'm intently looking at here. This stock was trading at near $75 just a couple of months ago. All right, stock number 2, another overreaction play is Wall Street Boots Alliance. You guys are making fun of me for that. Walgreens Boots Alliance, WBA, bouncing nicely here off the 200-day moving average after actually crushing earnings. It is oversold on the RSI for the first time since September 2020, and it is a value stock that pays a healthy dividend, trading at below where it was before the pandemic. All right, stock number 3 is Jets. This is the airline ETF. As opposed to playing individual airlines, you can play obviously Southwest, Delta, American, etc., United, whichever one you think has a better balance sheet, and obviously some have better balance sheets than others, less debt, etc. However, if you want a somewhat brainless recovery trade on airlines and on travel in general, look at Jets ETF that is sitting at the 200-day moving average as well, being oversold on both the MFI and the RSI. The last time it was oversold on the MFI was back in December 2020 when it went from $21 all the way to almost $30. The last time it was oversold on the RSI was in March 2020 when the pandemic just hit. Jets was routinely trading above $30 pre-pandemic. Now, it might take a while before travel is back in the shape that it was pre-pandemic, but the point is, this is a long-term play. This is not a swing trade. And we are looking for current discounts on value plays. All right, stock number 4, I'm going to give you 2, XLE and XLF. They're both similar, but one has to do with energy, the other one has to do with financials. So the S&P 500 does have different ETFs that deal with specific sections of the S&P. XLE, as I said, deals with the energy sector. XLF deals with the finance sector, and they are S&P based stocks. XLE is currently sitting at the 100-day moving average. We've been playing this stock since last year when it was below $40. It did hit a high of almost $60, currently trading at around $53. Again, this is a long-term stock. Before the pandemic, this was trading above $60. XLF also sitting at the 100-day moving average. Now, if I had to pick one over the other, I think there's more upside in XLF for 2022 and beyond, because when the Fed starts raising rates, or at least starts talking about raising rates, that is going to be good for XLF. When the 10-year treasury yield starts going up, if it starts going up, that is also a good indication for financial stocks. When the mortgage rates start going up, you will start to see financial stocks going up as well. As I mentioned before, the US banks have already passed the Federal Reserve stress test with flying colors. They already started initiating buybacks as well as dividend increases. And by the way, I think all of the stocks that I mentioned thus far, except for DraftKings, pays a healthy dividend. And the last stock that I'm looking at is actually quite a risky play based on the current market conditions and the stuff that I spoke about at the outset of the video. This is a risky play, so size accordingly. Please do your own research. Don't take this as gospel. Do your own research before investing in any of these. But this is TTT. Now, this is related to the treasury yield, not in the same way that TLT is. TLT goes up when the bond yields go down and vice versa. TTT is considered a short ETF, an ultra short ETF, which is a leveraged ETF. So when bond yields go up, this goes up as well, but in a magnified manner because it is a leveraged ETF. It is actually based on the 20-year treasury and not the 10-year treasury. But when rates go up in general, this will go up as well. And it looks like TTT hit a support level here at the 300-day moving average. And as I said before, if treasury yields actually hit a bottom and we expect treasury yields to go up, then we want to be in a treasury yield proxy play. And in this case, TTT, which is a leverage ETF, is a choice that you have. Otherwise, you could buy TLT calls, you could buy TLT itself. But if you don't know what you're doing, you don't know about leverage ETFs, you don't know how to read a chart, I urge you guys to go and research this stuff before just looking at a video and making buy decisions. This video is specifically designed just to give you ideas that you might not have thought about, give you ticker symbols that you might not have thought about, just put some ideas on your plate. You cannot really trade efficiently based on videos. People watch this video at later times. Sometimes I'll get people that watch a video that I made last month, the month later, and they're like, is this still a good play? I entered it. And I'm like, man, the market conditions are not the same as they were a month ago. So nuance is very important. Research is very important. Anyway, traders, if you got anything out of this video, leave it a big fat thumbs up just like this. Leave it in the comment section below. Let me know which one of these stocks you're trading. If I missed something, let me know what your outlook is on the market as well. If you want access to our private trading group, including that 300% DraftKings play, link is in the description below. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.